Hey everybody, welcome back to the weekly market analysis for the week ending September 22nd, 2023. Don't forget to hit the like button and subscribe to the channel. And you can follow me on Twitter at Mr. J. Thomason. And you can follow my Substack at befinanciallyfree.substack.com. The newsletter comes out every Sunday. First half of it is free, second half of it is for paid subscribers. And jumping right into the markets, this week's topic is that the markets have melted down this week. And so what's next? Where do we go from here? And obviously the big news this week was the FOMC this week giving holding rates steady, but taking out 50 basis points of cuts from their SEP for the next 2 years. So a lot of people looking at that as something that has jogged the markets down over the last few weeks, or I'm sorry, over the last week. So we'll just take a look at a few things to kind of get our bearings straight and to look at the technical levels. Looking first at the S&P 500. You can see here one of the things that we talk about on this channel is the importance of the tide line and the control line. One as an indicator of the overall trend, but then also as a place to take high probability buys. And one of the things that you have to kind of do is understand that no system is perfect and take into consideration the other conditions that are happening right now. Now, I still think that it's possible that we get some more upside. I was wrong on this over here in August being the bottom of the correction. I definitely thought price is going to move back up towards the all-time highs here. That obviously was not right, as we've made a lower low versus the August lows. And so the question is, where are the levels where we can be a little bit more sure of a spot that's a high probability buy? So normally what I would say is that because price dipped below the control line during bullish tide, that this would be a place to just hold your nose and buy. It's definitely always the scariest to buy at this moment, but you could also go back, if we go back just to the 2020 and 2021 bull market, then you can kind of see all the different places, especially early after the March 2020 crash. The places that were the best spots to buy often were the places where a lot of people out there were saying, oh, this is where everything's going to roll over. So, that was, we actually got below the control line back in October of 2020, and then we touched it a few times in October 2021. So that happens if you want to go to March 2020 pre-crash. This is obviously following the late 2018 Q4 bear market. We dipped below in May 2019, in August, in September of 2019, in October of 2019. And then if we go back even further, we can see instances, on occasion, so 2016 we had a bullish tide cross to the upside, dipped below in June 2016, November 2016, February 2018, April 2018, May 2018. And so all that is to say that when, if you go back through the history of, the time series, the tide indicator proves to be a great place on average, statistically, a great place to place buy orders. But of course, it's always it's always hard to buy when the price action looks the way it is here. But I do want to call that out because I think because you could make the same case on the NASDAQ looks better. The Russell just had a bearish tide cross, so that's obviously something that is concerning. But then again, we also got a bearish tide cross back in March on the heels of the SVB collapse, and that ended up being kind of a bottoming area. So the Russell's a little bit odd here. The Dow doesn't look super great right now. Kind of resembles more the S&P 500, but all that is to say that at least on the S&P, NASDAQ, and Dow, you're still in bullish tide. And I would be remiss if I just said, oh, because price has gone down quite a bit over the last week, that means that that price must continue to go down, because it doesn't have to. So there's a couple of things. This is a very uncertain time, and so usually where you have to think more on a discretionary basis is sometimes the different signals that you follow conflict with each other. And so when they don't line up, then often the best thing to do is to stick with the trends. And sometimes even the trends are conflicting. So if I asked you on this chart, is this an uptrend or a downtrend? You would say it's an uptrend. And yet, if you zoom in, you would say this is a downtrend. And so there's all that is to say is that in equities there are a lot of cross currents and there are a lot of conflicting signals. So normally this would be a buy because price is below the tide line, below the control line, and it's bullish tide. However, one of the things that you notice is that when the futures are down, or when the markets are down and close near the lows of the day on a Friday, there often is follow through into the next week. And so you see that actually quite a few times, not all the time, but quite a few times you'll see that take place, especially on a day like today where we traded up pretty high and then ended up closing down. And on multiple occasions intraday, if I pull up just the if I just pull up the 1 minute chart, you can kind of see the periods of time during the day where we tried to come up, especially towards the in the last hour of the trading day, and obviously we still ended up closing near the lows. So often that is an indication that the market is weak, and a lot of times that will translate into a poor open. There are a lot of people talking about 1987 and a couple of other times in history. I think the 1987 one sticks out to me, where price was down on Friday, and then on Monday that was when it had its huge crash in the 1987 stock market crash. So a lot of people pointing at that. So the recent price action is definitely something that is concerning on the bearish side. I also think from a technical standpoint, let me put my tide line back on here. I also think that on the S&P you've got this descent or this ascending trend line, which the market has respected, and I think that this is you could look and find that price might actually need to come down and touch this. It's around 4,300, so that's definitely something to watch out for, and that you'll want to take into account that the price definitely could fall down a little bit further. I mean, if you can hear the hesitation, I'm sure, in my voice. This is the kind of situation where using my candle indicators, I would wait for the candles to start turning yellow before I would consider the downside over. And better yet, if you wait until green, obviously you miss out on some of the turn, but then it's much safer, much higher probability. You can kind of see that in these different pullbacks, that if you just waited for price to turn the price candles to turn green again, it was just much higher probability of having winning trades than when the candles are red and trying to hold your nose and just buy. A couple of things that I want to point out, though, is if you look at the AAII investor sentiment survey, one of the things you see is a pretty 11% drop in the bullish percentile reading, a 20% rise in the bearish reading. The bulls bearish spread dropped from the 46th percentile to the 29th percentile. So that's obviously something of note. So investors got considerably more bearish this week. And then something else that I want to point out is, I use this plot in my newsletter, measuring relative strength and relative volume, and it's really interesting to note that obviously you've got a lot of weakness in equities and in the indices and in the sectors, and also in the style factors. And what you also notice is like SPY right here, OEF, that's the S&P 100, the Qs and whatnot. Those we're seeing not only weakness in the RSI, almost oversold or nearly oversold in the RSI, but they also saw increasing volume on a relative basis, which is supportive of the idea that investors could be just dumping and puking the lows. So, and I'm not saying that we are at the lows, but that is something to be aware of. And then another thing I wanted to point out is the market positioning having gotten considerably worse in terms of the S&P 500 and the Dow specifically. Definitely got more bearish on those. And so that's the left side, the left two sets of bars on the screen here. You've got the S&P and you've got the Dow. And I think that that's something to point out, especially on the S&P, is that speculators got even more net short, and that was just as of Tuesday, because the CFTC data is collected by Tuesday and then released Friday, so it's a few days old by the time we can update it. And so those kinds of things are suggestive of the idea that investors might be getting a little too bearish and piling in a little too much to the downside here. And so I'm going to be looking for sometime in the next few days going into next week. Let me just turn the magnet off. Whoa, that's kind of weird. I'm looking for price to catch on the S&P somewhere around here before reversing to the upside, and that's again it's kind of my base case, but anything could happen. I mean, could this be a crash and could this be a waterfall down? Yes, I think so, but I think the problem is that right now, I think it's been interesting listening to economic news out there talking about how everything is too extended and the markets are due for a pullback, and they're all talking about levels on the S&P where you should be a buyer to buy the dip. And the problem is that it's kind of two extremes. So it would be like if I told you, oh, the S&P has room to come back to 4,200. That may in theory be true, but these things have a tendency to either for price to not get to that target. So that would be like price getting here and then taking off while everyone's waiting for it to get to 4,200. Or on the flip side, the other extreme is that it hits 4,200 and that's when people start buying the dip and then it crashes below that. There's almost usually not an in-between on that. So all I'm saying is that you should beware the fact that everyone right now is talking about places where the dip should be bought. I take caution on both sides for that, because I suspect that the most likely outcome is that we don't get down to those levels that people are talking about buying at, or that we crash right through them. And so I think the fear then would be that people are setting you up potentially to buy the dip, but then this might not be the dip that you should buy. So I think that's something that you should be cognizant of. On the dollar had, if I recall, dollar had another winning week. So I think that's 10 weeks in a row now that the dollar has been green. It's just been on a rampage, and we are at the March highs from this year, and so that's something to point out. Anytime the dollar is overbought right now, so this could reverse and provide some relief for equities, but anytime you have a strong dollar and bullish tide on the dollar, that's going to be concerning for the markets. And then the yields today, it actually kind of it's interesting. We on the yields closed at our highest level yesterday in I think 17 years, and then today we're getting the downside reversal signal, which on these assets, it's not a perfect signal. It's just an indicator that that often does work. So for example, on the yields, if you look back, a lot of times those triangles pointing down do indicate good opportunities to sell, or I guess in this case this would be to buy bonds, but obviously not every single red triangle like this one right here from September 22. That was obviously not a good signal. So obviously you have to take these again with a grain of salt. You have to be able to stack your different indicators and your process together. But I do think that this could be the place where some relief is provided. I'll talk more about the bonds in just a moment, and kind of my views going forward that are evolving. But I just want to take a look at a few other things. Gold still going sideways, not really going anywhere. It's been saved by a couple of decent days the last few weeks that have prevented it from getting its bearish tide cross, which I still think is going to happen. But I mean, we're by the skin of our teeth, we may actually avoid that. So we'll see what happens next week with the price action. And then crude oil. I've been posting on Twitter about this a lot. If you follow me on Twitter, you'll have seen this, that one of the things that I noticed, like, look, if you just look on the week, crude oil looks like it's closing basically a penny up on the week, and to me, this is a sign that it's going to reverse. So if I pull back up my my positioning chart again, we're at the point where we're getting at extremes in terms of speculator positioning long crude, which is something that has been progressively, been getting steadily more long on speculator positioning for a while, and then we've had bullish news event after bullish news event. We've had, we had the today I think we had U.S. rig count was down by like 8 rigs or something like that. Yesterday it was the news of Russia, cutting off energy supply. The day before that, it was EIA inventory, with another, I think, like just multiple consecutive bullish prints in terms of inventory in a row, showing inventory shortage or tightening inventories. We had, the Russians and the Saudis talking about extending their oil cuts. We saw, news, I think on Monday or Tuesday, about the Saudis having like a 3 million barrel a day shortfall. So all of this stuff has happened, and price can't stay up. I mean, if you just look, so Monday we were up, a little over 0.5%. On Tuesday we jumped up pretty high, and on that day I tweeted saying, I think this is the near term top, not the top, but the near term top before a pullback, and I said expect a pullback, and then we ended up red on the day. And then the same thing on Wednesday, bullish EIA news, price went up and then sold back down. And then yesterday more bullish news. I can't remember which news yesterday was. I know I just said it just a little bit ago, but price went up and then it ended up closing down. And then today, a little bit less so. Price went up and took out the wicks of the last 2 days, and then at one point did go negative on the day, and then ended up closing positive about 0.5%. So this is prime for reversal, and in my opinion, what I suspect, because last time we came down towards the tide line but we didn't touch it, I think this time when we correct, we're going to go through it. And so I'm going to be looking for somewhere between 80 and 83 as the level to watch for a pullback. And then, of course, depending on what's going on in the global economy and in the U.S. economy, then that's obviously going to be a place to decide about taking another stab at a long, which, if you recall, like price back here in August went exactly where I said it would go, to the spot that I said would be a good buy opportunity. And, go figure, like if you measure that from that spot, oil went up almost 20%, 17 to 18%. So I've had a pretty good beat on this for the all of 2023 in terms of oil, calling all the different places where price would spike and then fall back down, and spike and then fall back down. So and then on the bullish side too. So and then crypto, just not good. It looks like that we might, again, if price is able to get back to the upside, we might avoid the bearish tide cross, but it just doesn't look super good for crypto. So let me go back again to the bonds and the yields for just a moment, because I want to I'm gonna change to to the standard chart and get rid of some of this noise on the screen, because I want to show you the 10. Oh, I need the tide actually. The 10-year 3-month. And one of the things I just posted about on Twitter recently, and I've been tracking this on my own for a while is I've done some work to look at what happens when the yield curve is inverted, the 10-year 3-month is inverted, and then what happens once you get a bullish tide cross. And basically the finding that I had was that within 6 months you will be at recession, within 6 months of the tide cross. And then the average time was just over 3 months, and the median was about 3 months in terms of, about 3.5 months was the median. In terms of the length of time it takes from a bullish tide cross from an inverted yield curve to the time that we're in recession. And that's, by the way, marking it from when the NBER declares the recession. And in most recessions that have taken place, the decline in equities and the boom in bonds, or the time to buy bonds, actually started before that. And so one of the things I found was that in the time series, when you get a bullish tide cross on the from an inverted yield curve, then that's usually an indicator that sometime within the next 3 weeks, 3 or 4 weeks, is a good time to buy bonds for the recession trade. And so that's something that I'm keeping in my mind too as I think about equities and bonds and things like that, because it obviously, my base case for a little while has been that we would get a correction. I was calling for a correction for a while, but I thought we were going to get a correction, and then at the correction everybody was going to jump in on the short side thinking we were going to roll over and go back down to the lows, but that everyone was going to get too bearish too quickly, and that this was going to give us another opportunity to move to the upside, and that it was that time where you would be looking for tops.